Are people concerned about what's happening with WTI and crude right now, or are they concerned about something happening in the future that's going to be worse?
I think what's always funny when oil events come up, and obviously this is a big one. This is not just the usual, there was a couple boats where they shouldn't have been, right? Yeah. Which you hear from time to time. Oh,
no Straits of Hormuz, sort of stuff.
This is a real thing. This is 5% of the world's oil production is now offline as a result of these attacks. That is why we see the price of crude settling higher by 14% today. That's not a move to sort of poo-poo and ignore and say it doesn't really matter. However, if we want to say this is the beginning of some global recessionary period, this is going to take some huge bite out of consumer spending that's going to set back where we thought the economy was headed, I don't really think we can say that right now. For one, U.S. consumer spending on energy, on gas, yes, as a percent of their spending, basically at record lows, yes, right? It's been a huge tailwind to the consumer for years, in the same way that mortgage debt is now basically a fraction of what it was, so too is spending on oil. So I think that changes where gas fits into the consumer wallet, as it were. Obviously, it's not going to be good if we have armed conflict in the Middle East for an extended period of time. But I think if the story last week was about markets, kind of reorient themselves around a view that the U.S. and global economy were not entering recession, I don't believe that this week's events in the energy market are likely to change that thesis. Obviously, if you're an energy investor, this changes everything. But,
yes,
I don't think we're all of a sudden energy investors. I think the direction of the economy probably is not greatly upset by this.
Well, let's bring in somebody who has his pulse on the energy investment space and dive into the attack that knocked out half of Saudi Arabia's oil production capacity. Joining us now is Dan Dicker, founder of the Energy Word. So, Dan, to you, the question that Myles and I were just talking about is the move that we're seeing right now based on the events that happened over the weekend, or fear out of what's next?
Well, I think it's both. I mean, clearly the oil markets have been underappreciating the geopolitical risk in the marketplace. I mean, there's been a lot of geopolitical risk that we've seen over the course of the last 2 years that very much, like Myles would say, has been poo-pooed by most of analysts and oil traders. And this last move by the Houthis, the Iranians, depending on how it plays out, you don't really know where it comes from. Ultimately, it is an Iranian kind of activity. It is something that is cheap, technologically advanced, in essence unstoppable. And what it does is not only make for an instantaneous kind of removal of a certain amount of production into the global marketplace, but leaves open the possibility of these kinds of attacks, which ultimately the market wasn't taking into account in the future. Like I say, they're very cheap. They're almost unstoppable. They can be targeted anywhere. Anywhere. This was very close to Riyadh, very far from the Yemeni border, a long way for drones to travel. And in essence, they hit their mark, almost perfectly. So in all ways, it's something to be feared going forward. And the oil market is now all of a sudden very, very frightened of these kind of geopolitical problems that could continue to occur going down the line.
Well, so then, Dan, I guess I would just ask, of the $8 per barrel, give or take, that was added to the price within the last 24 hours, how much of that do you think is the supply-demand imbalance now, right? There's going to be less supply with 5% offline as a result of this. And how much of it do you think is repricing that geopolitical risk, which you and many others today have said was pretty much not in the price at all over the last year or so?
Right. And I think it's mostly the repricing of geopolitical risk. What was taken out of the market is something that the Saudis will certainly be able to restore, not in a couple of days, but within 3 weeks, which ultimately for the global marketplace doesn't mean all that much. In some ways, Myles, this is kind of a kick in the pants to those who have considered, this kind of new age of oil, end of oil new age, where oil was going to remain at a low price beneath $60 for as far as the eye could see. I mean, it kind of puts that, in perspective and to task. And in a lot of ways, you've seen other places where supply has looked to be slowly but surely drawing out of the marketplace, while demand, although weaker this year, still is robustly increasing over the course of 2019 and 2020. For example, rig counts United States, they go down week after week, and not insignificantly. We're down 100 rigs from last year. I mean, ultimately, this is presaging the amount of oil that the U.S. shale producers are going to produce going into 2020. And, once you get a kick in the pants like this and oil goes up, wait a minute, this is not the only, supply difficulty we might see. It's not just from the Middle East. There might be a supply a drop coming from the United States and elsewhere. Venezuela, we know about, all over the world. In some ways, when I look at that $7, it's hard to parse how much of it is, column A, column B, column C. But I would say that the least part of it is, in fact, the loss of Saudi barrels for the next couple of weeks. That's the least of it.
So I guess also kind of an oil tourist question here, but I see the price of oil go up $8 a barrel, and I've seen how sensitive some of the U.S. shale players are, the smaller guys are, to rising prices, leading to them increasing production. Do you see that as a possibility here, right? If I've taken some rigs offline because I'm not profitable at 52, well, now if oil's back at 62, am I motivated to go out and start pumping oil and thus maybe bring the price back down a little?
Well, now you're in the center, Myles. You've hit on the head the problem with every oil prognosticator and oil stock prognosticator, and my difficulty going forward with my subscribers and the people who I speak to every day. So this is always the problem. There is this kind of catch-22 where the variance between how much surplus there's going to be in the market is dependent upon the long-term price of oil. And when you get, for example, a blast like this of 12, 15% in the price of oil, those high beta shale players who depend upon a higher price of oil, not only to increase production, but merely to survive the next 6 to 8 months. I mean, they're the ones who are going to get the blast of 20, 30, 40% in a day. Names like Continental and names like Whiting and various others we could name who have just taken off today in an enormous way.
Hey, Dan, we have been waiting for the Saudi Aramco IPO for a long time. What does this latest news do to that? Does it jeopardize it at all? Is it going to happen?
Oh, hardly, Jen. This is. I mean, for the Saudis, this is actually a very good news in terms of the pricing for their upcoming IPO. The IPO obviously has been accelerated. They made these huge moves in Saudi Arabia. They got rid of Al Fali and they put in Abdul Aziz, who's a son of the king. And it signaled, and they've named banks who they're ready to start, at least in a minor way, an IPO, a smaller float in a local marketplace as opposed to Hong Kong or London. It's definitely coming sooner as opposed to later. We have all these signs together, but ultimately the success of that IPO is dependent upon one thing, and that's the price of oil. So, when oil all of a sudden goes up 15%, it's bad for the Saudis. They're going to lose some production for a couple of weeks. But in terms of the price of their IPO, there's
But wait, Dan,
hundreds of $1 billion inherent in this move today for them.
But you've told us that these drone strikes are cheap and that they're essentially unstoppable. That seems like a big risk for a company, right?
Well, the price of the IPO or the value of the IPO is not in how much crude you can process today or tomorrow, but the value that you can place on the enormous reserves that are under the ground in Saudi Arabia. That's the lion's share of how you're pricing this IPO. So, in the end, oil gets out one way or the other. I mean, there are difficulties for a day, a week, a month, even a couple of months in terms of infrastructure that can be put at risk by attacks like this. But the price of the IPO is based on the value of the oil that's under the ground, and for the Saudis, that IPO is worth a heck of a lot more at $80 than it is at $50. It's as simple as that, Jen.
Dan Dicker, founder of The Energy Word, and he's also author of the book Shale Boom, Shale Bust, The Myth of Saudi America. Thanks so much for joining us.
Thank you, Jen. Bye.